This is lesson 8.2, recording closing entries. This is found on page 206 of your book. We need to have permanent and temporary accounts for a business. The difference is accounts that are used to accumulate information from one fiscal period to the next are called permanent accounts. These accounts are also referred to as real accounts. Permanent accounts include the asset and liability accounts of the owner's capital account. The ending account balances of the permanent accounts for one fiscal period are the beginning account balances for the next fiscal period. Okay. Then we have temporary accounts. Accounts that are used to accumulate information until it's transferred to the owner's capital account are called temporary accounts. Temporary accounts are also referred to as nominal accounts. Temporary accounts include revenue, expense, and owner's drawing accounts plus the income summary account. Temporary accounts show changes in the owner's capital for a single fiscal period. Therefore, at the end of the fiscal period, the balance of these temporary accounts are summarized and transferred to the owner's capital account. The temporary accounts begin a new fiscal period always with a zero balance. Okay. So how I kind of explain this is we have all these temporary accounts that accountants use all through the fiscal period to make it easy for them to know all the different types of like where our money's going. And then at the end, the boss says, I don't want to know all of these temporary accounts. I want one permanent account that shows me did we make money or did we lose money. So now we need to go ahead and close these entries of these temporary accounts, get those back to zero, and then have one permanent account that we can show our boss, did we make money, did we lose money, what's kind of that final line, or what's, what happened this year. So the need for the income summary account. In our income summary, on the debit side we'll have our total expenses, and on the credit side we'll have revenue greater than expenses. Okay, credit balance is the net income. This is what we were talking about in our worksheet. Depending on which side we put down will show if we have a net income or a net loss. So if we have a net income, our revenue will be on the credit side. This would mean that it's greater than the expenses. A credit balance is net income. If it's on the debit side, debit balance is a net loss. Okay. I would write these two things down in your notes so that you can remember net income or net loss in the income summary side. So we need to do our closing entries now. Again, this is really important that you've read this section before you're watching this, or it won't make a lot of sense. So again, if you have not watched, I urge you to please pause this video, go back, read, and take notes, and then come back. Our closing entry for an income statement account with a credit balance, okay, so a net income. We'll write our heading, which would be closing entries. So this will go below our adjusting entries that we just did in the last section. Then we'll write the date, be the 31st of August. Then we'll write the title of the account being debited. So sales are always credited, right? So we had $35.65 in sales, and we can see that in the income statement of our worksheet. Okay. We are going to take all this money that's in sales, we're going to debit it back to sales, because if we have a credit of $35.65 and a debit of $35.65, that should equal zero. So our temporary sales account will equal zero, and then in our income summary, what needs to be credited, we'll put that money there. So basically what we're doing is we had an envelope that had $35.65 in it. We're going to take that money out of there. Okay, so we're going to debit it to make this zero balance, and then we're going to move all that money from that sales envelope into the income summary envelope so that our boss can see how much money we made. Okay, that's kind of how I like to think of it, so that my brain can kind of remember which is the credit debit side. All we need to do is whatever it is here, this credit side, we need to debit it so that it gets to a zero balance, and then we need to take whatever money was left over, that $35.65, all that money, and credit it in the income summary side. Okay. Closing entry for income statement accounts with debit balances. Okay, so all of these are temporary accounts that have a debit balance. We're going to write income summary, and we're going to debit the total of those numbers. Okay, so since all of these were debited, they're all going to be credited here, because we're going to take all the money out of these envelopes, make them each a zero balance, and put them into income summary. Remember, our debit goes first. That's why our income summary is on top here, and in the last slide it was on the bottom, because last time income summary was being credited. Okay? So we're going to take advertising expense of $213 and credit it. Insurance of $100, credit it. All those will be credited. Once we get those done, we'll add them up, and the total will go into our income summary on the debit side. Closing entry to record net income or loss and close the income summary account. Here was our net income in the income statement debit side. This was capital credit to record a net income. So to close our net income, we will debit our income summary and credit our capital. Okay, so this was a debit here. We need to move it to our credit, which would be our capital, because our amount of net income is our capital of our company, depending on if we're making or losing money. Okay, so that will go in the credit side, and then again we're going to close to income summary, which will be a debit. Okay, closing entry for the owner's drawing account. Here we had a debit of our Kim Park drawing. It was a debit of $625, so now we need to credit our $625 here. When we're closing drawing, instead of closing to income summary, we need to close to capital, because remember, our drawing is what money Kim Park has taken out for her personal use. So that's going to take the amount of our business down, the amount of money our business has down if we're taking money out for personal use. So because it was a debit here, we're going to credit our Kim Park drawing and then debit this Kim Park capital of $625. So we've closed this envelope and we've put it into our capital.